Hello, I'm Curt Long, Vice President of Data and Research and Chief Economist for America's Credit Unions. I'm here to unveil the third quarter update of our economic and credit union forecast. You'll notice a lot of changes since our April forecast. At that time, we were only beginning to digest President Trump's Liberation Day tariff announcements. That was a key reason why that forecast was pessimistic. While tariffs rose to historic levels over the past 3 months, it has not been as severe as initially announced in April. It was also reassuring that the administration dialed down tariffs in response to financial volatility, showing it is not going to court disaster while pursuing trade policy goals. But while our outlook has brightened, there are still concerns. As of early July, the average rate of implemented and announced tariffs is around 20%. That is the highest level in the U.S. since the early 1930s. The hiring rate has stabilized, but at a level well below the pre-COVID pace. And consumers, the engine of the economy, have slowed their spending. Adjusting for inflation, growth in real consumer spending was flat over the first 5 months of the year. During the first quarter of 2025, real GDP growth was negative. While that is a dismal result, trade volatility right before President Trump's tariff announcements may have played a role. If so, there should be some degree of payback in the second quarter. What's more concerning is the broad pullback on spending from consumers. But we are not overly concerned about that getting worse. There are a couple of reasons why. First, the budget reconciliation bill signed into law on July 4th carries a big fiscal footprint. We would expect those households benefiting from lower tax rates to spend some portion of their savings. Also, consumer sentiment is rising as the stock market continues to climb. Our forecast group now puts the odds of recession by 2026 at 40%. That is down significantly from April, when we placed those odds at 60%. But it's still uncomfortably high and reflects that a rough patch could cause growth to dip below zero for an extended period. The labor market continues to surprise in a positive way, with the unemployment rate holding around 4%. However, some concerning trends are emerging. Year-over-year growth in average hourly wages has fallen for 7 consecutive months. Since early 2024, the unemployment rate for young workers is up over 2 percentage points. Meanwhile, the length of typical unemployment spells is increasing. While these trends could threaten to produce higher rates of unemployment, it is mitigated by a slowdown in labor force growth so far this year. That means fewer new workers need to be hired to maintain a stable unemployment rate. Moving now to interest rates, one result of a more optimistic outlook for the economy is reduced odds of rate cuts. We previously anticipated 2 rate cuts in 2025 and 5 in 2026. We've dialed that back to just a single rate cut this year and 4 next year. Tariffs do present a complicating factor when it comes to monetary policy, since some portion of the tariffs will be passed on to consumers in the form of higher prices. While this impact has not shown up in overall prices yet, we do see some evidence of it in goods like furniture and appliances. Let's turn now to our credit union forecast. During the first quarter, share growth fell short of our forecast and remains low by historical standards. We expect that the Fed won't begin easing monetary policy in a significant way until 2026. Without lower interest rates, share growth is unlikely to notably exceed our forecast because of persistent competition from money market funds and internet banks. Loan growth, however, was somewhat stronger than we expected to start the year. One bright spot in the economy is the home resale market. Listings and purchase applications are growing. It appears that the lock-in effect, where homeowners with mortgage rates well below market rates were delaying listing their homes, is starting to wane. Home price growth is beginning to slow as well. However, construction activity is also down sharply, and the effect of reduced new home supply should prevent prices from dropping in most markets. Finally, one of the biggest changes to our forecast this quarter is a welcome one. We made an upward revision to 2025 ROA from 40 to 65 basis points. Our forecast group discussed a number of factors, including a better outlook for loan performance. During the first quarter, credit union delinquencies dropped sharply and are essentially flat versus a year earlier. With better loan performance, we expect credit unions to reduce funding loss reserves. That wraps it up for this economic update video. You can find our complete forecast using the link in the video description. Thanks for watching, and we'll see you next month.